The worst thing we sell is 5 times over collateralized, and it's been unrated. The best investment grade bond in the world isn't 3 times over collateralized. So the worst thing we sell is better than the best thing in the conventional finance establishment. But, you know, as we say, the struggle is real. And, you know, and we have to like walk before we run. And so this is a never-ending, nonstop campaign, charm offensive to persuade the politicians, persuade the regulators, persuade the credit rating agencies, persuade the big money managers, persuade the mega banks. Morgan Stanley, the first deal they did where they were the lead underwriter for us was Stretch. Took us 5 years before we got Morgan Stanley to lead our IPO. So we're winning, but I guess the good news for everybody is we're going to keep winning for the next 10 years. And there's 40 quarters during which Vanguard will first accidentally own my stock, then they will grudgingly let you buy it, then they will allocate 1% to it, and then they'll be like, wow, I guess it's a good idea. And what I say, and I've said it, Scott, and you've heard it, it's like, by the time the bankers tell you it's okay to buy it, it'll cost you $1 million of Bitcoin. And when they tell you it's a good idea, it'll cost 10 million of Bitcoin. So you're getting a 99% discount right now to do the work yourself and show some courage. And you get a 90% discount, you know, when they make it easy for you, but you'll pay 10 times more. You know, we've made good progress so far. Like in the first 6 months, BlackRock's PFF, which is a $15 billion ETF that holds credit and generates yield, they actually allocated like 3.5% of that fund to our credit instruments. So we managed to get, I think they became one of the biggest investors in Stretch. They bought $200 million plus of it in one day at one point. So we got some support from credit investors, but I met a lot of insurance companies and a lot of fixed income investors, and they said, tell us when you get a credit rating because then we can buy it. But right now the mandate on our fund is we can only invest in rated credit. So, you know, credit investors are the most risk-averse investors in the world. And so if the endowment said do this, but make sure you've got no more than 5% or 10% allocated to this rating level, then as soon as you get that rating level, well, now we actually pay 2 to 3 times the yield of everything else. I mean, the truth is, you know, and obviously I'm biased, but I think most of this credit is garbage. It's like preferred stocks from 5,000 banks, and they're all opaque, illiquid assets, and they yield you 4% after tax. And it's like, why would you buy that stuff, right, when you could have something 2 or 3 times better or 4 times? Our preferreds stretches 100 times to 200 times more liquid than the stuff that people actually put in your portfolio. So I think it's the things will speak for themselves, but we fight against, you know, the prejudice against crypto.
And what you're offering is incredibly compelling, obviously, in the current environment, but we know that regardless of what Powell does in a couple of months, there's going to likely be a Fed chairman who's accommodative as far as rates going down. So isn't that going to open even a wider ocean between what you're offering and what's readily available? Also, there's $7.5 trillion right now just sitting in money markets waiting for an excuse to enter whatever asset is that investor's favorite flavor of the month.
When SOFR falls 100 basis points, all your money markets immediately get repriced down 100 basis points. All the corporate bonds will be repriced down 100 basis points. Mortgage-backed securities, all of the conventional credit instruments of the 20th century, corporate credit, real estate credit, sovereign credit, it will all be repriced down. We will actually just enjoy the spread, and our message will be, look, now we're even 100 points better than we were, because at the end of the day, again, doomsday for us is, oh, Bitcoin goes up 20% a year instead of 30% a year, or 40. So I think the big idea is conventional credit is crippled by design. Like, why would a company pay you more than the bare minimum? They don't want to. But also, conventional credit is built on crumbling, depreciating assets. Like the credit is backed by hardware that depreciates. It's backed by a house that depreciates. It's backed by an iPhone 17, which will be obsolesced by the iPhone 19. backed by a company that's, got a depreciating interest, or it's backed by currencies that are, being debased. So I think that digital capital rewrites the playbook for credit and digital credit. I never really looked at this as a competitive game where the companies in the crypto market are competing with each other. My view is we are competing with 20th century credit instruments and 20th century equities and 20th century financial entities, right? And so if you come up with a better way to how many people in the world want to get paid 10 or 12% after tax on their capital? Well, like everybody. So who's losing? And the loser is going to be whoever's selling the junk crippled credit instrument that's backed by a weak company. They'll have to pay a higher rate or they won't get the capital. But the winner will be the investor, and the winner will be the nation state. The winner will be the companies that bring these new products to the market. So I think in DeFi and digital finance, the idea is, hey, let's just do everything a million times faster. Move the money at the speed of light. Let the computers, trade it a million times a second on the weekend, and let 400 million companies raise capital over the weekend by selling a token instead of taking 4 years and $40 million of lawyers. That's the idea. Smarter, faster, stronger. And in the capital markets and the credit markets, the same idea. It's like make the capital work smarter, make it faster, make it stronger, right? And the loser is going to be the 20th century. And the 20th century deserves to lose.
Buyers of these instruments, who do they have to be? Do they have to have a deep belief in Bitcoin like you do to believe in these instruments and purchase them? Who do you see as the future buyer of digital credit?
The beauty of digital credit is we took all 4 of those things public on NASDAQ. So any place where you can buy a NASDAQ stock, you can buy them. If you've got money locked up in a retirement account in Australia or UK or Europe or a 401k, you can buy them. They just got listed on Robinhood. We lobbied Robinhood for about 9 months, and those are the first 4 preferred stocks that Robinhood ever listed about 2-3 weeks ago. So you can buy them anywhere. You can buy any security, and they're totally compliant. And in terms of the risk you're taking, well, it's kind of simple. It's backed by Bitcoin. So if you think Bitcoin's going to zero tomorrow forever, then your collateral's bad, so you don't want to buy it. It's like buying New York real estate if you think New York's going to sink under the ocean next week. If you believe that Bitcoin is solid, a solid capital asset, then that's the first thing. And then the second thing is you have to trust the issuer, which is we're a $100 billion company in business, public since 1998. So we're lucky to be reasonably well known and credit worthy, and we've got $75 billion of capital. If you trust the company and you trust Bitcoin, then it's fairly straightforward. It's like at that point your choice is, do I want 3% from my money market, or do I want 10% or 20% tax equivalent from one of these instruments?
Obviously see their savings account yielding 1% in an environment where bonds are 4 or 5%. Obviously, you talked about a 20 or a 10 or a 30-year bond. This is crushing all of those.
Yeah, so, SOFR, the US dollar rate, short, like 1 month rate or short-term rate, is the highest in the Western world. It's 410 basis points right now or something. And money markets are kind of tied to SOFR and USD. But the banks are paying on average 40 basis points. Like if a lot of banks give you 10, 20, 30, 40 basis points in the US, they're giving you nothing. After the money markets, corporate credit rates are tied to it. So investment grade will get you to 4.5%, 5%. Bank preferreds are yielding 5.5%, 6%. Junk bonds are 6.5%. Private credit is 7.5%. So conventional credit in the United States is anywhere from 4% in a money market to 7% for private credit, and the banks are giving you very little. But that's the best it's going to be in the Western world, because when you go to Canada, ratchets down to 3%. When you go to Europe, it ratchets down to to 1.8%. When you go to Japan, it ratchets down to 50 basis points. In UAE, it might be 3. In Singapore, it might be 2 or less. And in Switzerland, it's negative. And so these rates are pretty much, they're all headed to 200 basis points or less. And so what we're talking about is an effective yield of 5x more than that, but a tax equivalent yield of 10x more than that. And the thing that's interesting about our company is our product is the credit. Like, that is the product. So if you said to me, Mike, you can sell 10% yielding euro credit and sell $10 billion of it, or you can price it at 5% yielding and sell $1 billion. The conventional company would take the 5% and sell $1 billion, but we would take the 10%, market it, and then go look to sell $100 billion because we want to ship the yield, because our use of proceeds is paying us 20. And so for us, we're probably the biggest well-run company who's intentionally keeping the capital to invest in Bitcoin and trying to pay the highest possible credit yields. And what we do intentionally, enthusiastically, would get you fired if you worked at Apple or Amazon or Google or Microsoft. So we're repricing the cost of capital, working to invert the world order for corporate finance. And our mission is we want everyone to get paid 10% after tax, or 10% tax deferred on their short-term treasury holdings. That Stretch IPO is the biggest IPO of the year. It was 1 basis point of the treasury market in the US. It's 1/100th of 1%. Our goal is to be 1%. And if we're 1%, the company's going to be $1 trillion company, and we're going to buy $300 billion worth of Bitcoin just with that one little instrument.